Hello, I'm Tej Patel, UK Head of Regulation and Client Lead Partner at Capco. Thank you all for taking the time to join this webinar. Today's session is a part of a series that we will roll out over the rest of the year, where we aim to discuss the critical issues affecting capital markets and the industry as a whole. 21 is going to be a busy year for most risk and capital management teams, with many high impact regulations on the radar, ranging from Basel III, CRR2, and the EBA's IBR repair package. Today, we're going to share our insights on how most effectively firms can address these challenges in an ever-changing and shifting regulatory landscape. So in order for us to do that, we've got a fantastic panel lined up. So if I can introduce the panel, we have Damien Saville, who's Program Director for Wholesale Banking Transformation at HSBC, with over 20 years of experience working on a range of initiatives across capital management, including RWA optimization, model implementation, transformation programs covering audit and counterparty credit risk. So thank you very much, Damien, for joining. We also have Constance Usherwood, Director of Prudential Regulation at AFME. She has worked as a policy expert at the EBA on promoting supervisory convergence in relation to CRR. So again, Constance, welcome and thank you. We also have Simon Hills, Director at the Prudential Capital and Risk at UK Finance. He leads the Prudential Capital and Risk team, which focus on influencing the implementation reforms to capital liquidity requirements in the UK. He also leads UK Finance's work on the Senior Managers Certification Regime, which seeks to improve bank-wide governance, culture, and has extensive knowledge on prudential regulatory architecture. We also have Nikhil Talwar, who is a Senior Consultant at Capco. He has domain expertise from a capital markets perspective. He's an SME in the regulation and risk practice. He's got extensive experience in developing policy and implementing modeling changes in response to regulatory challenges. So in order, and I've got the pleasure of moderating this session, for us to get kicked off, I'm going to hand over to Nikhil, who'll talk a little bit around the upcoming regulatory landscape, the challenges and the competing timelines that everyone has.
Thank you, Tej, and welcome everyone to the first in this series of discussions on risk change and regulatory implementation within the banking industry. In the decade since the financial crisis, there has been a seismic shift in global banking regulations, and capital frameworks and risk operating models across the entire industry have been in a consistent state of flux. The complexity and scope of successive regulations has impacted all aspects of banks' risk operations, from portfolio strategy to policy and framework, IT architecture, and data governance. The ongoing challenges faced in simultaneously implementing the Basel III, CRR2 requirements whilst preparing for Basel IV have once again underscored the importance for banks to develop a more holistic approach to risk change, as the potential implementation synergies can provide significant opportunities to minimize any negative impact on ROI and enhance market competitiveness. Despite the extension to timelines provided in response to COVID-19, there is still a waterfall of upcoming regulatory initiatives with overlapping scope and conflicting delivery timelines. The slide in front of you highlights the upcoming risk and capital regulations that banks need to consider for 2021 onwards. With CRR2, including elements of FRTB's capital reporting and LIBOR transition all coming due this year, these upcoming initiatives will impact the end-to-end risk lifecycle across both trading and banking books. The recent rejection of the EBA CRM guidelines by the PRA, with its policy implications for delivery risks for banks for operating across UK and Europe, has once again highlighted the delivery challenges that banks face. Banks often face the same set of issues when it comes to implementing risk regulations. Despite the diverse coverage of these regulatory initiatives, there are common impacts across a number of areas, including business and portfolio strategy, covering both traded and banking books, risk operating models, most notably impacting RWA methodology, end-to-end business processes, collateral treatment, and global and regional reporting. For example, second-order risk, which is a specific EBA requirement, is also required to meet the CRR2 large exposure reporting standards. We have liquidity frameworks, in particular for certain traded product classes, data requirements and governance, which as of this week is back in the spotlight, given the PRA's report a few days ago on its review of data collection within the financial sector, the aim of which is, in their own words, to shape the evolution of reporting over the next 5 to 10 years. And most of all, IT architecture, including the shift to cloud-based storage and reporting, which ties in with what the regulator's long-term vision. Given the scale and scope of the changes, the figure you see on the right reflects the main planning stages that banks need to consider at a strategic level when approaching regulatory implementation. Whilst the regulatory initiatives can often change or be amended following industry consultations, and as always are open to interpretation, having clarity on the future state capital and RWA requirements is a critical foundation for effective implementation, making it easier to define the strategic goals. The new capital requirements, in particular the output floor, funded and unfunded collateral treatment, and modeling restrictions, will affect both retail and institutional portfolios across all asset classes in the traded and banking book, with significant impacts to market competitiveness. Banks should take this as an ideal opportunity to revisit their business and portfolio level strategy by identifying capital-intensive exposures and setting internal hurdle rates based on the bank's strategy, risk appetite, and ROI commitment to its shareholders. The overarching business and portfolio strategy will itself determine the bank's overall risk appetite, as it seeks to reduce capital charges by targeting RWA-reducing businesses that can boost its profitability. By having a clear risk strategy, banks can more accurately define their future state and focus their budget accordingly before embarking on a multi-year transformation journey, which itself is subject to change. However, before the future state can be defined, banks must first review their current state, which often includes fragmented policy, framework, and IT architecture, resulting from previous implementations and years of tactical fixes. In our experience, this is the most important stage, particularly for IT development, as banks who have a comprehensive overview of the current architecture can more accurately define an efficient and transparent future state and a defined transition path to it. Having a clear and accepted future state itself will align stakeholders and help clarify accountability for delivery. This will help drive strategic outcomes and ensure finite budget is prioritized on long-term solutions rather than conflicting tactical deliveries. Without this, there will be differing visions from stakeholders, which are informed by existing businesses and regional practices, local regulatory requirements, and legacy processes that have been in place for a long time. With the change impacting across business, IT, risk, and finance operations, budget and resource allocation is also a core issue, made critical by the specific skill sets required for each stage of delivery. It is common to underestimate the budget requirements and the time required to securing the right talent, particularly in areas such as policy and framework, risk methodology, data governance, and IT development. The result can often be a lack of adequate skill sets, which are often siloed instead of being available across functions. Finally, we have the change in implementation itself. The holistic implementation plan should link the deliverables to strategic outcomes with clear accountability and dependencies. Without a formal delivery plan, it will lead to a fragmented approach requiring successive replans as regulatory requirements are updated or as project risks emerge during implementation. These are resolved in isolation without reference to a strategic outcome itself. I would now like to hand back to Tej for the first of our panel discussions. Thank you.
Brilliant. Thanks for that, Nikhil. As mentioned in the chat, if you have any questions that you want to ask any members of the panel as you go through, please feel free to put them in the Q&A tab, which hopefully you can see right next to the participant box. But whilst people are thinking of their questions, I've got a couple that I'd like to kind of pose to our panelists, if I may. So if I take the first question that I think we'll open up with, Constance, if I can ask, please, from your perspective, what are the key Basel III modelling impacts and other regulatory hurdles on the horizon that could create challenges for banks?
Thanks very much. It's great to be on this panel today. I think the first thing to note is that while Basel III was agreed in 2017, there's still a lot of very open questions about how it's going to be implemented locally in the EU or the UK. And although there are some changes which banks are already making, other parts aren't going to be agreed until the very end of the negotiation process, for instance, in Europe. So we're talking end of 2023, end of 2022. And then by my estimation, banks won't necessarily be required to implement in Europe until early 2024, and that's at the very earliest. And I think this is going to cause a lot of challenges and make it difficult to operationalize. And it's important that banks will have enough phase-in for that. There are three areas I'd like to touch on quickly in terms of challenges which I see. Firstly, the Basel III change, which is going to have the biggest impact, will be the output floor. And this is really going to run to the wire politically in terms of how they agree to calculate it and the level of application, whether that's at solo or consolidated level. And there's a lot of consideration on this method of how it's calculated, which could become very complex for banks to incorporate within their systems. So there's already 6 different variations around whether it applies to a full EU capital stack and you floor the Pillar 2 and the SYRB at the same time, or whether you do even potentially a kind of parallel approach, which is pretty controversial, where you calculate the floored Basel stack and the unfloored EU capital stack, and you apply whichever capital requirement is higher. So then banks would maybe circumvent having to floor some of their IRB models there. Secondly, the move from IRB to FIRB. This is going to be interesting for financial institutions and corporates, but banks are already doing this as part of their IRB repair work. There is, however, uncertainty around what the treatment for foundation approaches will be in 2022 and what capital banks will be required to hold there. And there are also some nitty-gritty issues that will come with Basel III that haven't had any discussion or consideration. So for instance, there's this threshold for modelling of 500 million euros. What does that include in terms of the corporate size? What happens to corporates that breach that 500 million threshold? Is there going to be some kind of phase in, phase out for those corporates in terms of how in terms of their eligibility for modelling? And then also you have EAD models which move to foundation, while PDLG models retain IRB modelling. How does that work in practice? And then thirdly, you have areas of overlap with the IRB repair work proving very challenging, such as the loan origination and monitoring guidelines, which is quite a heavy going piece of work to implement, especially for banks with larger global footprints. And also, I think, we had today announced the PRA consultation on their post-Brexit implementation of the IRB repair work. What does that mean for model approvals that are kind of already in the pipeline? And if they suddenly decide to consult on the credit risk mitigation, for instance, which is going to be part of Basel 3.1 rather than just implementing the EBA guidelines. So those are some of the points that I'd throw out there as probably quite challenging for banks at this moment in time. Thank you.
Brilliant. Appreciate that, Constance. Thank you. Kind of follow up on that a little bit. So Simon, can I ask you, what holistic approaches have you been seeing used across the industry?
Yeah, I think absolutely, Tej. Key objective for us as we talk to regulators, to supervisors, is a consistent, holistic and coordinated approach to prudential capital, prudential liquidity. Clearly, for a bank like Damien's, facing off to 50 or 60 different supervisors in all likelihood, the less fragmentation there is, the better. That allows better optimization of capital. And of course, we all want the same capital for the same risk, regardless of where that particular exposure is housed. And one area where there could be a holistic approach taken, I think, is between prudential capital and liquidity, or capital in this case, and IFRS 9. I know some banks are trying to tie up the two exercises together, but I think it's been difficult. And as Nikhil was saying, I think more banks are running these as separate projects, which leads to that siloization that Nikhil was talking about. And I think too, here in the UK, in a post EU world, we may see divergence between the UK and the EU, which may not be helpful, as Constance mentioned. We've seen that the PRA is going to consult on credit risk mitigation and economic downturn scenarios, both of which are key inputs into LGD modelling in relation to wholesale models. And banks, although they've got a bit more time now to submit those wholesale models, perhaps not until this time next year, because of the governance processes, because of needs to data clean and all that sort of thing. There's a tremendous amount of work going on those wholesale model developments right now, and being told, well, we're having another think about economic downturns, being told we're having another think about credit risk mitigation, and what are the implications of that? Are the implications of that, though, that the PRA will be gold plating the EBA guidelines, the technical standards? I don't know, but I hope not. But that's the inference one would perhaps draw from that. And another instance of this is possible divergence between the EU and the UK is in relation to the approach in the CRR2 quick fix to software assets, where the PRA has been very clear how skeptical it is about the value of software assets in resolution, and has been very clear that too, that it doesn't expect banks to take the capital benefit that's afforded by CRR2. And I think banks have recognised that in their year-end accounts, where either they've shown the capital benefit because, if you like, it's a legal requirement, but then they've also disclosed the extent of that benefit so that investors can back that off in the anticipation that in the short to medium term, the PRA is going to come out and wave its finger and say, no, you can't take that capital benefit. Other banks have not taken the benefit at all. I think another area where we like a more holistic approach is the setting of MREL. You'll know there's a discussion paper out at the moment on MREL. It's got a number of thresholds in there which are particularly irksome, I suppose, to challenger banks that are growing rapidly in relation to transaction account volume and in relation to asset size. Those thresholds were developed really back in late 2015, and the number of tools in the Resolution Authority's toolkit has grown substantially since then, and the PRA is undertaking resolution assessment frameworks, and so an operational continuity and resolution continuity of access. All these additional tools have been added to the resolution toolbox, and we're very concerned that the PRA, the Bank of England PRA Resolution Authority, should take a more holistic approach to the different tools that it's got, and use this as an opportunity to think again about MREL. So I think if we could get supervisors to look at the metrics, the tools they have now in a more joined up way, that would be and holistic way, that would be good for all of us.
Yeah, as you said, it can be quite complicated when you've got different regulatory bodies with different priorities, with different views. So that holistic approach and the points you made are valid. I'm sure you've got a lot of people virtually nodding their head at that. So thank you for that. Damien, from an industry practitioner perspective, what, in your experience, which of the functions are proving the most difficult to be able to pivot to this new and upcoming set of regulatory requirements and obligations?
So most probably on our side, both Nikhil and Simon and Constance have touched on it as we've worked through this, is obviously the policy team is having to deal with a whole bunch of things that are constantly evolving and changing, and having to provide us with interpretations of how we implement things. So that provides quite a tough challenge for them, and constantly having to go through the practice of interpreting things and trying to then also be a little bit clear about, excuse me, about the Basel III reforms, that there are areas open to interpretation. And obviously for HSBC especially, we cover a very big part of the world, and looking at that across those different regulators, and as Simon was mentioning, it provides quite a lot of complexity that makes it harder for you to be able to implement things, and especially to change things for the output floor, or for the change to foundation, or the things that they've alluded to earlier. And then the other thing, I think that the area that's taking its time to get on top of this as well, which is struggling slightly, is the data side of things, and the data management and governance around that, and in the sense that obviously we're now moving to a cloud-based reporting and those things, and we have areas in the world which are not happy about that. So you're having to have on-prem solutions to certain ones, and you're having to have a cloud-based solution to others. It's also the data management and compliance of this, and what I'd basically refer to as dynamic customer data. So external ratings that can change, turnover values that can change, a lot of these metrics that drive the output floor, those have to be captured and they have to be updated and they have to be kept constant for the move to foundation for large corps and a variety of things that happen like that. So I think those are probably the two challenging areas. I mean, there's the architecture problems, which are innate at most banks because you've been set up to do calculations in one way, and now you're being asked to do it across a portfolio basis. And in some cases, you know, as the example with large corporates, you're going to move from foundation to advanced if it goes up and down above the 500 million. So, you know, those kind of op models and controls and change implementation things and business process changes for architecture also prove quite challenging. So I think there's a lot of changes here that are constantly evolving, and as I think we've realized with the regulatory space is that it's always evolving. You know, leverage ratio came in a couple of years ago, which was a new addition. That's driven changes now. Basel III reforms, as Simon was mentioning, the credit risk mitigation stuff's going to change again. You know, and well, hopefully not too substantially, but it's always keeping on touch of that, on top of that, and then obviously making sure that we're flexible enough to be able to deal with that. But it's quite challenging to do that.
Definitely, further to what Damien was saying, I mean, one of the main issues that I've encountered with data is ownership, you know, especially for cross regions, who owns what data, who takes responsibility for, you know, defining the attributes, for looking at the data quality, the sources of this, and especially considering the interlinkages between a lot of the deliverables. That's definitely a core issue. Further to what Constance was saying a little bit earlier on, with regards to treatment of certain portfolios, I actually work on the unfunded credit risk mitigation delivery. And one thing I've noticed is that the regulations will approach it from a very cut and dry. For example, anything less than 500 million can still use, for example, LGD modeling. But in terms of implementation, this creates a lot of challenges because portfolio structures across banks, especially large international banks, cannot be cut up or tranched at that easily. You'll have different kinds of counterparties, different kinds of deals, different kinds of treatments for collateral. And then on top of this, you'll have different treatment across each region. You will have, for example, PD substitution, you'll have LGD recognition through PD. Sometimes you'll have LGD modeling as well. And getting uniformity across all the regions is, in order to meet those regulatory requirements, is proving difficult. And then obviously, since it's all open to interpretation and, you know, the regulators will come back with changes, it does sometimes feel like you can spin your wheels. So I definitely think that that's one of the biggest implementation challenges with things like modeling, and especially PD and LGD across portfolios where there are different kinds of clients, different kinds of asset product classes, and different kinds of exposures.
Brilliant. Appreciate that, Nikhil, and thanks for the views of the panelists. So look, we've talked a lot about challenges and the difficulties going to be faced by everyone. Can we let's move on to hopefully something a little bit more on a positive, forward-looking basis of what are the kind of recommendations and strategies and approaches that firms can take in this kind of challenging environment.
Thank you, Tej. So further what you're saying, I'd like now to walk you through the key implementation challenges that banks face and to offer some insights and recommendations based on our industry experience. As you can see on screen, we've got a number of challenges over here. The first being business models and portfolio strategy. As previously mentioned, having a clear overarching business and portfolio strategy at the outset is imperative in defining the most material impacts, and therefore prioritizing the implementation requirements that will actually maximize RWA optimization efforts. In our experience, banks that tend to combine data analytics tools with regulatory policy at the planning stage can more easily identify the most material RWA sites. This allows for a restructure in portfolio strategy, which in turn can allow for a clearer future state definition and implementation driven by ROI and growth potential. By employing qualitative and quantitative RWA impact assessments, we believe that banks should be able to optimize their portfolio structuring to target selective asset classes and exposure categories, thereby reducing their top-line capital charges. The second is regulatory requirement definitions. A lack of clearly defined requirements can lead to parallel work streams across regions, as has been noted throughout this call, businesses and functions with the conflicting goals and targets. This can complicate and delay interlocks, especially when it comes to future state definition and therefore planning and even budgeting as well. Core to defining this is having a centralized regulatory and policy team, which cuts across regions and risk classes, which can provide a single point of authority on regulatory requirements. This will make it easier to assess the impacts of new regulations and officially carry out gap analysis on the existing frameworks, leading to a more accurate future state definition and therefore budgetary planning. The EBA second order risk requirement is a perfect example of this, as it is equally essential to the accurate delivery of large exposure reporting, itself a CRR2 requirement, and for supporting concentration risk monitoring at an accurate level. The next is global IT and framework transparency. Banks that do not have a clear picture of their current state will struggle to clearly define the future state that is informed by business strategy, without which there will be conflicting visions from stakeholders which are informed by existing business practices, local regulatory requirements, and legacy processes that have been in place for a long time. So firms need to map out their existing business and region-wide IT architectures, creating a taxonomy of systems and tactical processes to assist planning and future state design. In our experience, identifying legacy systems and creating a clear end-to-end process flow is a major challenge, especially for large international banks. By employing tools such as knowledge graphs, banks can aim to create a network view of the current IT architecture, and the resulting transparency will help identify overlaps and synergies to better refine the system requirements, define that future state, and ultimately the project roadmap itself. Next is implementation methodology. In our experience, banks often attempt to employ agile techniques to improve the momentum and granularity of delivery tracking. However, while these techniques may work well in focused areas such as IT development and micro delivery, they are less effective when applied to policy and framework decisioning, which can often require multiple working groups and rounds of analysis before a conclusion is reached, let alone a policy position actually even be drafted. This can often lead to inaccurate internal KPI monitoring, forcing clients to engage in costly and sometimes unnecessary replans. By deploying agile techniques based on the type of work and decisioning process, for example, data remediation versus policy and framework, banks can select the appropriate tool for the job, preventing inaccurate metrics and unnecessary budget and timeline impacts. Data quality remediation. Now look, poor data quality is nothing new, but establishing data governance can often be unnecessarily cumbersome due to lack of clear data ownership, as I mentioned before, conflicting data sources, difficulty with reconciliations, costly quality controls, and data requirement overlaps between work streams. By employing analytical tools such as entity resolutions and complexity spectrums, firms can quickly establish clear mapping, join up data keys, and actually define key attributes. In our experience, the subsequent transparency will assist firms in broadening and deepening their databases while ensuring a clear governance process, which will form a solid foundation for future enhancements and regulatory reviews. This is particularly important considering the PRA's announcement a few days ago, where the Bank of England have identified 3 key areas for reform. First, defining and adopting common data standards that identify and describe data in a consistent way throughout the financial sector. Secondly, modernizing reporting instructions to improve interpretation and implementation, 2 key points that have consistently been raised throughout this presentation. And finally, integrating reporting to move to a more streamlined, efficient approach to data collection, which goes hand in hand with what we've all been talking about when it comes to banks' drive to move to cloud-based IT structures. Finally, we have human capital and resource allocation. The complexity of risk and capital change requires a certain degree of technical product knowledge, data expertise, regulatory knowledge, and an understanding of how internal bank processes work. Whilst banks often have the required skill sets split across functions, regions, or businesses, it can be difficult to aggregate them. These therefore need to be complemented by employing people with strong planning, training, and communication skills to complement the core SMEs. Without these, deliveries can be delayed. This is especially true in areas such as risk modeling, policy development, collateral legality, and end-to-end testing. Firms can take a different approach to certain functions, especially things such as quantitative risk modeling, where key skills, whilst hard to come by, can be employed across asset classes, risk types, or business functions. The upside is that firms can reduce their project delays, budget waste, and delivery risks caused by these resourcing issues. I would now like to hand back to our panel for some additional perspectives on these challenges and potential solutions. Thank you.
Thanks, Nikhil. So following up on what Nikhil has just taken us through, Constance, if I can ask, considering challenges that banks in the industry face, how can they influence policymakers to kind of highlight these pain points when it comes to regulatory challenges?
Yeah, well, I think Nikhil's highlighted some very useful, practical recommendations there that banks can take internally. And I think that's certainly going to help. But from a kind of policy perspective, what I would say is that while sometimes regulatory principles are agreed, they're going to happen. So Basel III is going to happen. There is often an open door for phasing in and kind of looking at the best way of implementing it according to the local market. And this might be something that you want to do with your supervisory discussions with your JSTs. That's often, you know, one way forward, but you can also do it as part of kind of industry-wide regulatory initiatives. So this is generally where AFME as an organisation steps in. If that's a problem that we see all banks are facing. The key for this is to be able to demonstrate where the pain points are and provide the data if possible. And also to provide some kind of justified sequencing. So as you build models and regulatory solutions, we need to know what order it's needed in and what makes sense. And that will hopefully ease some of those pain points. You know, you don't paint the walls of a new house if you're going to pull down the ceiling. And, you know, as I mentioned earlier, that seems to be something that could potentially happen now with the PRA's revised approach to the IRB repair work that was announced today. You know, the EBA banks were in the process of kind of implementing all the new EBA rules, and now that's kind of just been thrown up in the air a little bit. So we're going to have to look at that going forward. And it'd be I'm always open to listen to kind of banks on what we can be saying to get us to a sensible approach. And we have had success on this as well. So for the IRB repair work, we spoke quite often with the EBA about the process for that and the timeline, and that has resulted in this extension of the deadline for introducing changes to the rating systems by 1 year to the end of 2021, and also the delay to the changes in LGD and conversion factors for low default portfolios to align with Basel, which I'm sure they were considering in any case because it's a very sensible change. But I think it helps the industry kind of puts these on the table and shows where the kind of most sensible route forward is. Once the principle of the policy has been agreed. And again, as well on guidelines on loan origination monitoring, we were very involved in the consultation process there, spoke quite often, had a big meeting with the EBA. And I think we've got a much more sensible phased in approach to monitoring, especially with this delay for, well, this kind of 3-year process and timeline. I'm sure some banks still would like longer, and the longer you have to implement, the cheaper it gets as well. So that's always a consideration. So I would say that when you're implementing, it's not just a downstream policy unit tells you something that you've got to do. I'd also urge those people implementing to feed those issues upstream and to ensure that you can say, well, we know this is coming and this is going to be a huge challenge. So for instance, that corporate threshold of 500 million euros, no one's come to me and said to me, it would be really useful if we had a kind of 6-month model phase in, phase out for corporates that breach it. I'm sure that is possible, or that might be something that people think about, but I don't know, and it hasn't reached the policy teams, and it's something we can influence now, and we can get kind of changes to the law to make sure that that is considered. But that's what I would suggest for this call. Thank you.
Thanks, Constance. And then Simon, what trends or maturity levels do you kind of see across the industry?
You know, Tej, I think it varies. It varies. Let's be frank about this. Everything is built on data and systems. I think firms that have recognized that early and thought about well-designed, consistently labeled, if you like, data pools are doing better and are capturing information better, you know, supported by maybe artificial intelligence, so they can optimize their capital, and doing that to, as Nicola was saying, absolutely to support their business strategy. But I think many firms are continuing to run the programs that we were reminded about earlier as separate projects, siloized projects. And I think that does lose the benefit of cross-fertilization opportunities. I think it probably results in more consumption of what we all know is a very scarce resource, IT resource. So I think lots of firms, perhaps not Damien's, but some of the mid-tier firms perhaps have got quite a lot of work to do on that, particularly as they face up to the challenges of wanting to move from the standardized approach, or then the revised standardized approach under Basel 3.1 to the IRB approach. But I do think the Bank of England's plan for reforming regulatory reporting is going to focus our thoughts on that over the coming years, on the importance of data. And I do think that's very much a helpful move by the bank. And I know a number of firms have been involved, as UK Finance was, and I think AFME was too, in engaging with the Bank of England as they put that plan in place. And I think too, we perhaps need to think a bit more about the extent to which industry can share data. So UK Finance collects a lot of data on mortgage performance. We collect data on operational risk, but I'm sure there are other data categories that we could all think about contributing together to a common industry data pool. And as we go through our conversation today, if other sorts of data requirements emerge, that could be serviced through some sort of industry pooling. I'd be very happy to talk to you about that. So I think, to answer your question, Tej, it varies, frankly.
No, I can understand that. So if we look at it from a practitioner perspective, Damien, and definitely not to put you on the spot on this one, but what do you think have been the kind of key decisions or approaches that have put you on the right path from an HSBC perspective?
So I think obviously we're looking at the Basel III reforms, but generally HSBC works in silos, as I'm sure lots of organizations do. But one of the better decisions that we've done is for the Basel III reforms program, we're running it as a wholesale point of view. So instead of doing what we would normally do, which is run it as a global banking or as a commercial banking venture, I actually work with so I represent global banking, and we have a commercial banking program manager that we work together, and we run it as a wholesale program, basically. So it means that the solutions that we're implementing for collateral and a variety of other things, the data solutions and things like that, are aligned, and we look at it as a holistic view. And that kind of also translates into the next kind of good decision that we made is that we take, as the business, we take a little bit of ownership of the end-to-end life cycle of data and end-to-end calculations. Now, we don't own the calculation engines, and we don't own the risk parameters and things like that, but we have a relatively large team, and there's quite a few people from Capco that are actually part of that are looking at the end-to-end cycle, the end-to-end data flows, and we're trying to make sure that systematically everything flows from one area to the next, and that it ends up in the final reported numbers to the PRA, as an example. And to add to that, what we also try to do is that we've also tried to look at things holistically, in the sense of we're not purely looking at the the final RWA numbers. We're also looking at what happens from a modeling point of view for that data. To the point Simon was making earlier, we need to make sure that the data that we're using, that is being inputted by relationship managers, is flowing through downstream, that it's also then being translated into a modeling landscape for model derivation for PD, LGDs, and all those kind of things. And I think those are probably the critical things that we're trying to do in this view of the world that most probably hasn't happened before. It's where we're trying to take a holistic view and an end-to-end life cycle view of data and the way things work, and then try to join everything up. So we're trying to fix things with not only one view in mind. I mean, an example is that we have to post adjustments because there's some deficiencies in systems. What we're trying to do is we're actually looking at those adjustments now and using them as a touch point to see, okay, where are the breaks in the systems? How do we, as part of the work we're doing for Basel III reforms, how do we actually go and fix some of the historical problems that we've had? And most probably some of the system limitations that you had when you implemented systems 10 or 15 years ago, that, obviously IT has moved on immeasurably from what it was with cloud and all the rest of that stuff. Just working that stuff in and trying to make sure that we prepare for the future. But that's kind of hard with the ever-evolving landscape that there is.
Definitely further to what Damien was saying there. I mean, I've worked across a number of banks doing implementations, and I think the end-to-end accountability and ownership that he was talking about has had a huge impact in terms of actually making progress, defining what our deliverables are, and also just building up momentum as well. I mean, looking at it strictly from a UCRM perspective, this is a regulation which will cut across many different regions, and there are a lot of tactical processes and fixes which were in place, and just kind of being able to create a taxonomy of those and kind of dig up those old processes, and kind of you end up laying a much more solid foundation, because I mean this regulations are going to continue for the next 10 years. It's a consistent waterfall. This is just the future state of banking going forward. So I would definitely say having that end-to-end ownership has made that a lot easier compared to previous experiences, and I would definitely recommend that.
Okay, thank you. Look, really interesting views on how to kind of address those implementation challenges and approaches that firms can take. So look, we're moving into the kind of Q&A section of the webinar. So whilst we've had a couple of questions come in, I'll still encourage you to please sending them through. So I'll start with the ones that have come through, but if we can keep them coming in, that'll be much appreciated. Right, which ones? Constance, if I may, what impact will COVID-19 have on the upcoming reg requirements of the 2021 deliverables? What's your kind of views? What are your views on that?
Yeah, so yesterday I was actually on a very interesting discussion on our AFME Spanish Capital Markets conference, talking about kind of the role of securitization of NPLs and when the wave will come of COVID NPLs. And I think there's some quite interesting data from the European Data Warehouse that I think which has been published recently, which is showing that actually repayments are picking up. And so there's a kind of question around like how much will be reperforming and what will be the actual size of the wave. Will it meet this ECB 1.4 trillion estimate that has been touted, and will it come kind of end of this year or 2023? And I think the consensus was actually kind of 2022, whether that's beginning or end. And so that will definitely feed into the Commission's considerations of CRR3, and the challenge will be kind of keeping an ongoing analysis of that as that goes through the process of negotiation, and how to reflect that kind of best in the proposal. It means that they're probably more inclined to ensure that European specificities are respected as much as possible, or kind of considered as much as possible. So things like specialized lending might get quite a lot of focus, and that might change some of the proposals there. And because I think there's a lot of challenges for European banks implementing the Basel III changes. And I think then there's also kind of whether they do a separate stream on non-performing loans or not. There is this massive disposal LGD special treatment that runs until June 2022. Whether that will get extended or not is something to consider. I don't think there'll be any changes to the provisioning backstop that was implemented a year or two ago by the Commission. But those are some things that will feed into the discussions for sure. Okay,
thank you for that. What else we've got on here? Brexit.
Tej, I'll just add on that. I think the 1 year delay in implementing Basel 3.1 was very welcome, announced back whenever it was, sort of end of April last year. I don't think anybody should be assuming that there is going to be a further delay. I think the Basel Committee specifically debated a 1 year and a 2 year delay back in April and came up with the 1 year. Unless we get a truly awful wave 4, I think everybody should be planning that this is going to come in at the beginning of 2023. You've all got your programs underway, and I know the act of pausing a program can be as difficult as the challenge of delivering the time frame to what is now an extended project requirement. So I think people should not be hoping beyond hope that this is going to get delayed again. I don't think it is.
Thank you for that, Simon. And just as a question I'll direct you on Brexit. So how are things starting to change following Brexit, and what impact do you expect it will have?
Well, I think that, with the CRR2 quick fix example that we saw earlier on, with the consultation on economic scenarios and on CRM, we're seeing that the PRA is wanting to do its own thing. Now, I think Constance and I agree that looking at this late stage at the economic downturn requirements that are in the EBA material, looking again at CRM is not helpful because banks are cracking on with this. But I think we can also recognize that, in the approach to software assets, the PRA is going to stay very close to Basel 3.1. The national specificities that Constance was talking about, it's going to take a lot of convincing. I think if it's in Basel 3.1, its starting point is it's going to do Basel 3.1 here in the UK. So I think we'll see some possible divergence from the EU approach towards the Basel 3.1 approach, and that comes with attendant risks of gold plating too.
Okay, thank you for that, Simon. We have another, which I think Damon, as a practitioner, that kind of makes sense to come to you. So from a top 3 challenge, I know you've kind of touched on challenges and how and what you're seeing that's being done internally that's helping, but are there kind of top 3 things that kind of worry you the most at the moment? What would they be?
Data. It's probably the most critical, and then obviously future architecture for what we're looking at in the terms of that we're trying to move our platforms, and we're trying to come up with a more efficient way of doing things. So the changing landscape, and then obviously the non-finalization of the rules in the sense that we can use what we have at the moment to do interpretations and to work off that. But it's adding those 3 together, which creates the complexity and the moving parts that we're trying to work with. So I think that the hardest part, and obviously the PRA is picking up on this, is the data. Is data quality, and that is quite critical, especially for the output floor and things like that, where you were very driven by PD, LGD, and things like that when you did a capital calculation. The standardized calc uses a variety of kind of, as I said, dynamic custom attributes, and those have to be kept up to date. And you need to put in op models and controls processes to make sure that they're reviewed. Also making sure that you have ways of checking that they make sense, and that you're not having your data quality called into question by the PRA. So I think the biggest challenge is data at the moment, and I'm sure that's true for most banks. And obviously it's the moving data from credit application system all the way through to a reporting system, which creates we need to create a linkage issue. You have facility linkages, product linkages, whatever. So from my point of view, and for the program, that the critical thing that I articulate the most with my guys is that we need to make sure that the data we onboard is the data we end up with, because that would be our view of how we get to the optimized RWAs for the capital output floor and for the IRB calcs.
Damien, a question from me, if I may. To what extent does GDPR, the ability to transport data across national boundaries? You've got lots of national boundaries at HSBC. Does that have you tearing your hair out?
It does, and I think that's part of the problem with the cloud and things like that. Is obviously you have places like China that have very specific things about how they want data treated, and you run into, like, we have random things like Indonesia have proven to be like quite picky about the data and things like that. So you find these pockets of places where you don't have that much of a presence, but they do create you an unnecessary headache because of exactly the GDPR relationship and the governance and that. And that's what I alluded to earlier when I said is that it's all of those kind of things that, data to me is a lot broader than just the actual data. It's the governance around it, making sure that it flows correctly, making sure that you're on top of it, making sure that, I read a stat as we've been going through this, that, data quality decreases by 25% year on year if you don't do something about making sure that's in place. Now, after 4 years, that means your data quality is down to nothing. So, I think those are the things. It's just these anomalies that pop up as you go through it, and as you're running such a big and complex program that covers so many areas, which makes it tricky to stay on top of all of it. And the changing regulation just adds to that.
I mean, further to what Damien was saying over there, I mean, something I've noticed is just it really emphasizes the importance of just defining that ownership right at the outset, whether it's end-to-end ownership, because it definitely does help inform those discussions in terms of IT architecture, the flows of the data, and when it comes to decisioning on portfolios which have cross-border exposures. For example, you have guarantor, which is based out in China. You have an obligor, which is based in France. You have to find ways to account for the different ownership of that data, the definitions of those as well. So if you manage to tick that box right at the outset, it not only helps you do that, but it helps support that ongoing governance, which, as Damien said, decreases every single year. It's so important to keep on top of that, and just to make sure that each of the teams understand what they have to do to ensure that quality, that freshness of the data, the refreshing of the sources as well. It's definitely made a big impact, in terms of which banks I've worked out where they didn't have that, or they took a very fragmented approach as opposed to ones which kind of identified that very early on.
And on that point, Nico, right, you mentioned something earlier in the presentation around knowledge graphs. Can you give an example of how that, one a little bit more about what knowledge graphs are for those that don't know, and then how that could actually be used in scenario where you've got multiple regulations?
Sure. I mean, all the way throughout this conversation, we've been talking about approaching regulatory implementation from a much more holistic perspective. We're taking that into account when you're doing your planning, when you're defining the requirements. And to that end, knowledge graphs are really just an analytics tool that help you build a network view of the problem. You can apply it to any stage. So you can apply it to, for example, different regulations which interlock. You can apply it to IT applications, data flows. But to answer your question, I mean, let's say, for example, a knowledge graph, you would have different regulations and you'd be able to map out all their requirements and impacts and see at what stage different stakeholders or different work streams have already progressed through that. So, for example, something like second order risk, which has significant synergies with large exposure reporting and dependencies from concentration risk, you may find that certain regions or certain work streams have already ticked those boxes with regards to data, with regards to portfolio structuring, and as the implementation progresses, the emphasis on certain areas will kind of reflect that. All it is just it kind of helps inform the planning stages and the implementation by allowing you to focus your attention on particular areas and synergies between the different work streams. So if CR2, which is coming due for large exposure reporting later this year, there'll be a number of areas which are or have already been achieved. And so when you look at second order risk, you may find that you only need to really focus on, let's say, policy or sign off or maybe aspects of the reporting. And this just kind of helps streamline the implementation. And the impacts are definitely felt in terms of delivery timelines, KPI monitoring, and ultimately budgeting as well.
Okay, thank you. Well, look, we're coming towards the close. I'm not seeing any new questions that we haven't kind of covered earlier or in some of the free flow Q&A. What I would like to do is get a final thought from each of the panelists, if I may. So, Constance, if you wouldn't mind kind of leaving a final thought for the audience, please.
Yeah, I think I would. I just wanted to pick up quickly on one thing which Simon mentioned, which is he mentioned that there will be no further delay. I completely agree with that. What I would say is that it will take the EU until the end of 2022 to agree the legislation, to agree the framework. They will then clearly give banks at least another year to start before they have to start implementing and applying those requirements. And there will be kind of phase in as well for things like equities. I know that they're considering, say, a 5-year phase in from the IRB to the SA in terms of that change. And so just bear that in mind. I mean, from my side, I would say, think about the phasing in, think about what's logically possible from your side, and feed that upstream to your policy people. And, while some things are fixed in terms of the general policy, there is a lot of scope to ease the challenges ahead. And certainly at AFME, and I'm sure UK Finance, we're there to help you do that. Thanks.
Brilliant, appreciate that. Simon, could I get your closing thought, please?
I think with the way that the UK government is planning to implement Basel 3.1, in the UK, it should be a more flexible process. So Constance and I have both worked to various degrees in Brussels, and we know, as you were saying, Constance, the tortuous process of getting from a Commission proposal to actually the thing that the Commission has proposed, after it's been through Council, after it's been through Parliament, actually being live and finalised, and something that people can start planning to. I think it's going to be a bit more fleet of foot here in the UK now, and do take the opportunity to respond to the consultation papers that we're seeing at the moment on implementing CRR2 in the UK. That's which runs out CP 521. Do get involved as we respond to the consultations on some of those technical standards and guidelines we were talking about earlier on, and do get involved as we hear from the PRA about their plans to implement Basel 3.1 in the UK, the final bits of it. That consultation probably now looking like it's going to emerge at the end of Q3, maybe Q4. Whereas I was a bit concerned at the beginning of the year, we were going to do the CRR2 consultation and then straight into the Basel 3.1 consultation. I think we've now got a bit more of a breathing space. So let's use this opportunity to work together to identify what it is that we want to focus on in Basel 3.1 as it's applied in the UK. Is it the level of application of the output floor? Is it the use of origination value for mortgage LTV calculation? Let's work together to put a good case to the PRA before they go final with their proposals.
Excellent, thank you for that, Simon. Damien, if I can ask for your kind of closing thought, please.
Well, I mean, I would kind of end on a bit of an upbeat thing and saying that it's quite a challenging environment to work, but it is quite it's rewarding as well, because you obviously have a lot of things that that are moving and you have to take into account, and it's not a static BAU function that we work in. And so from that point of view, it is exciting, although it is challenging, and it will provide quite a lot of opportunities as well. So from that point, I think you just have to kind of knuckle down and work through all of it.
Brilliant, appreciate that. So look, it leaves me with a minute left before close. So I just wanted to, on behalf of Capco, everyone who's listened, thank Damien, Constance, Simon for joining, providing some very, very insightful views and thoughts for people to think about as they kind of look at this journey over the next couple of years. So again, thank you. And just for everyone who's made the time to be able to join, again, thank you for joining. As I said, we look forward to seeing you in the next couple of sessions that we'll have over the course of this year. If you have any questions on this topic or anything else, you can reach out to myself, Nikhil, or any member of the Capital Markets leadership team, which are up on the screen. So again, everyone, thank you for joining, and stay safe.